So, good afternoon, everyone, and welcome to the next session on the power of pensions. So, just before we begin, I wanted to just give you a quick reminder that if you have any questions throughout the session, please do submit them on the app, and I will give them to Nigel after the speech. Also, as always, please feel free to tweet about this session using the hashtag PLSA Annual 19. So, next, we have Nigel Wilson, the Group CEO of L&G, discussing how pensions could be a force for good in society and creating intergenerational opportunities. Nigel's had a strong commitment to inclusive capitalism, and his view is that policy failures create opportunities that have resulted in his appointments to a series of government and regulator groups, such as patient capital, life sciences, social care, and climate change finance. So, how can our industry embrace the power of pensions? Nigel, over to you.
Thank you. Good afternoon, everyone. It's always a thrill to be here in Manchester, particularly so soon after the mighty Newcastle beat United. It doesn't happen very often. I'll start with a statistic. $28 trillion. That is the assets in pension funds across the OECD. It goes without saying that 28 trillion is a huge sum of money, but by way of context, it is certainly not enough to give most of the aging populations of OECD countries the standard of living they expect to have in retirement. The capital isn't enough, but also the yield is not enough. What we have to do is improve the lives of people through the power of pensions. At the moment, we're simply not doing enough. Another piece of context, 28 trillion is coincidentally more or less exactly the amount of money that will need to be invested between now and 2050 if we are to achieve the rate of increase in global warming of less than 2 degrees centigrade. Investing in climate change will help the yield on pensions. Pension savings, DB or DC, is the closest direct connection that most people have with capitalism. It's their stake in the system. It includes them, so is inclusive capitalism. Global capitalism, winners and losers. The system in which pension saving plays such a key role has, since World War II, been the system of increasingly globalized capitalism. There is a clear alignment between successful market economies and the accumulation of wealth through higher returns to provide income for retirement. But globalized capitalism has delivered mixed results. It has lifted literally hundreds of millions, in fact billions, of the world's poorest out of absolute poverty and hunger. It has created middle class in many developing countries. It has also created huge opportunities for entrepreneurs and managers in the Western world. But, and it's a big but, those returns have not been enjoyed by those in the fourth box shown on the slide, poorer and increasingly middle-class people in rich countries. Median real wages in the UK and the United States have not kept pace. They've been virtually flat for the last 25 years. One unintended consequence of this is the relentless search both for short-term returns and the lack of inclusive capitalism. This has resulted in a boost of the appeal of populist politics, a boost for the search for often more radical solutions, whether they're on the left or the right. The irony is that despite the emphasis on global political uncertainty, the fundamentals of the UK economy are strong. In the UK, we have record employment, 33 million people at work, the highest labour participation rates anywhere in the Western world. We actually have a skill shortage. Vacancies at close to 1 million are at an all-time high. Median real wages at last starting to rise. We have record company formation. We're a world leader in startups, fantastic science, huge progress in many great cities, and we have many of the best universities in the world. So, how do we reconcile every pension saver's need for a successful stake in the capitalist system with the need to deliver visibly better conditions for everyone today? the potential of inclusive capitalism, and Salford is a great example. At Legal & General, we truly believe in inclusive capitalism, where investment is both economically successful and socially useful. What we all have to do is self-determine societal success. And what do I mean by societal success? Here you see it in action just down the road. Salford has been on a 100-year journey. In 1900, it was a busy dock with high employment but low skills, low pay, poor housing and poor health. In the late 19th century, Manchester had the highest per capita income of any city anywhere in the world. It is now not in the top 50, despite its recent success. Global capitalism by 1980 had turned its docklands into a wasteland. No employment, no skills, no pay, destruction, but not creative destruction. Long-term investment of pension savings has, in the last decade, helped to transform Salford. Media City, shown in the photo on the right, alone now employs more people in digital media than ever worked as dockers. There's high pay, high-skilled jobs, and a key component of Manchester's growth story. But Media City is not unique. There are more cranes on Manchester's skyline than ever before. This proud city is now being successfully regenerated, and pension savings are playing a critical role. Gloomy future or factful solutions. What is happening in Manchester is also happening in Leeds, Bristol, Bath, Birmingham, Newcastle, Glasgow, Edinburgh, Cardiff, Oxford and Cambridge. L&G indeed can take some credit for this. We've invested over £20 billion of long-term money right across the cities of the UK, with much more to follow. When measured by a combination of jobs and population increase, Manchester has seen the fastest city centre growth in England and Wales in the last 15 years, followed closely by Leeds and Birmingham. Our great cities are not overbuilt. They are under-demolished. We have to invest in the new. London, surprisingly, was in 20th position. For those working in the metropolitan bubble, including the majority of UK's opinion formers who don't venture beyond the M25, this comes as a shock. Our great cities potentially have a good deal further to go. But we face a clear choice as an industry. We could listen to the gloomy futurologists who claim that geopolitical uncertainty over trade, Brexit and China are an excuse to wait and see. Or those who claim that artificial intelligence and robotics will erode job markets, like the Luddites before them. The risk of all of this is we create a self-induced recession. Or we could lean in positively to the three great trends of the moment. First, the global trend towards urbanisation, with corresponding historical underinvestment in our cities and their associated infrastructure. Second, technological advances are the most exciting they've ever been, certainly in my lifetime, and are happening at a pace never seen before in health, in well-being, transport, energy, media, retail, and many other areas. Third, there is abundant cheap money around the world, with $17 trillion earning negative nominal yields, and a corresponding search for even modest yields in real assets. This adds up to a compelling case for more long-term investment in the real economy, creating real jobs that pay real wages in our great cities. And indeed, market failures are perhaps becoming economists sadly are becoming even more gloomy and not recognizing that market failures are creating a world of opportunities. I have a PhD in economics, but not a PhD in gloomy economics. One reason is that we live in a world that is long of problems and short of solutions. But market and policy changes and failures also create real business opportunities. One example is the pension risk transfer market, which has become a £30 billion annual market here in the UK and similarly sized in the United States. DB schemes and sponsors are de-risking the challenge of an ageing demographic through buy-ins and buyouts. It's a $5 trillion global market. It enables annuity funds to invest in all sorts of opportunities, in real assets, which we can see here in Manchester, but in Oxford, Leeds, Newcastle, Cardiff, and indeed in many other cities. The circle on this slide is ours to grasp. And indeed, this is another great example of markets creating a world of opportunities. This is Legal & General's recently executed £4.6 billion pension risk transfer deal for the Rolls-Royce Pension Fund. At about the same time, we announced we would be investing up to £4 billion in postgraduate and key worker housing in Oxford, as well as a number of science parks and wet laboratories with Oxford University. And indeed, Oxford has a major issue in accommodation, housing, affordability, and the need for its scientific startups to become real scale-ups and businesses of the future. We expect about 70 to 80% of the investment in new assets in Oxford will indeed come from our pension risk transfer business. So, the pensions of retired aero engineers from Rolls-Royce will be invested in the facilities which will create the aero engineers of tomorrow. This is wonderful, heartwarming synergies at work. This is the power of pensions to both earn an economic return but deliver a social value as well, despite a world of lower for longer interest rates. The UK DC market, as Emma often reminds me, is an unstoppable wall of investment and cash. As we all know here, the gradual runoff of DB pensions and the gradual de-risking of more DB through buyouts will be more than offset by the growth of DC pensions. Pension reform and auto-enrolment were an example of a rare thing, a huge policy success here in the UK. A decade from now, we'll be looking at a UC-DC market that is likely to be around £1 trillion. When we consider the power of pensions we have in DB, de-risk DB or annuities and DC, this is an amazing opportunity for all of us. But although it's a bit convenient for me as a speaker to have three things, there's a fourth thing we need to talk about. For many people, their mantra is "my house is my pension." The unfortunate thing about this approach is that it can be complicated turning an asset, usually the person's single biggest asset, their house, into an income. It is a significant point that the over 55s in England alone own over 1.5 trillion of housing equity. There is more value locked up in housing, often underused or unsuitable housing, than there will be in DC pensions, even a decade from now. Much of this pension isn't helping to deliver income for pensioners. This has to change. We have to find innovative solutions that deliver greater income for retirees. Big questions for our industry. So when we examine the big questions for our industry, I think there are two. How best we can help people make use of their pension savings, including their quasi-pension housing, and also how do we maximise active engagement with long-term saving. Pensions should ideally pass the pub or dinner party test, just as we talk obsessively about house prices at dinner and in the pubs, even when there is no intention to liquidate our housing asset and it is almost an academic conversation. So we should be talking in the pub or around a supper table about what is happening with our pension. This is shorthand for greater engagement, an area so far in the industry we've not been good at. And it's absolutely terrific today that a fellow Northeasterner, Steph, an expert on engagement, is going to follow me on the stage. Pensions are an important source of financing. One way to foster greater engagement is to emphasise precisely the investment power of pensions. I suspect for many, if not most people, where their pension money is invested is largely a mystery. It disappears into the city or Canary Wharf or Charlotte Square, or some other centre which is seen as financial alchemy. The task for us is, however, relatively straightforward. It is to join up this large source of patient capital with a series of chronic underinvestment. And we know this to be true in housing, built to rent, affordable, later life living, infrastructure, clean energy, healthcare, and the growth of new businesses, which, as we saw earlier, will deliver high pay and high skilled jobs, and to do so in a way which generates the right returns for long-term pension savings. Seeing investments is the route to believing in investments. Ideally, we would foster engagement best by demonstrating the local relevance of our pension investment. My pension owns a bit of a laboratory in which my son is working. My pension helped deliver the flat where my grandchildren are growing up, or is investing in a startup company where my daughter works. The technology exists to make this level of engagement possible, and it can sit here on my phone. And the sums of money that are available for investment from DB, DC, and for quasi-pension housing dwarf the government's capacity to invest, and indeed dwarf the often 20, 30, 40 million pound of inward investment which all governments like to trumpet about. This is Pension City. Patient capital can transform our cities. This is a future city. There is no single place like this in the UK, but there will be in the future. At Legal & General, we've invested in all the components of this future city shown here. Housing across all tenures, transport infrastructure, renewable energy that is clean, is green, and increasingly cheap and cheaper than conventional electricity. Educational facilities is something else we're investing, as well as growing companies. All of this is fueled by pensions. But, and indeed it's a big but, there are many things we haven't done, which are work in progress. As they say in our school reports, we could do better. And that is certainly true for Legal & General as a company, but I also think it's true for our industry. First of all, drawdown investments. This is a £20 billion industry that will become a £40 billion industry. The simple pension accumulation landscape of yesteryear, i.e. annuities, is massively changing in a DC world. We think the annuity will continue to have a major role to play, perhaps bought with part of a pension pot or bought a little later than in the past. But we do need an attractive range of compelling drawdown investment propositions. This is very much work in progress. So ideas will be gratefully received by myself and the L&G team. Second, we need to continue to work on the creation of new assets. With the abundance of money available, we cannot simply invest in bidding up the price of old assets. It is economically rational and society useful to create new assets like those shown in Pension City, or to pick some real live examples, Central Square in Cardiff, the Helix in Newcastle, build-to-rent housing in Leeds, student accommodation for Imperial College, the science parks we're building across the country, digital distribution centres, etc., etc. Third, hopefully somebody will crack the challenge of engagement amongst pensions. This is about a combination of data, transparency, and true engagement. It will play into consumer curiosity, and it's a natural extension of ESG investing. It may not happen tomorrow, but it has to happen, and we have to be the people who make it happen. And fourth, the issue of monetizing quasi-pension housing equity. We have lifetime mortgages already, and that's a £4 billion per annum business, but it will become a £10 to £20 billion industry. We'll see a massive amount of innovation in this area, and there'll be crossovers between mortgages and pensions and exactly where they meet. These assets are, of course, themselves potentially useful investments for pension or annuity funds in the future, requiring defined cash flows. We'll also see retirement interest-only mortgages, which is another potentially huge multi-billion pound industry. This is a taste of what is to come in the future, driven by a combination of very high house prices and very low interest rates and more complex, non-linear lives. Many of us no longer get that linear life. We get educated, get a job, get a house, raise a family, repay a mortgage, and then retire. This isn't the 1950s or 60s anymore. We have several or indeed more complicated families. We have multiple jobs or gig careers. We retire later or not really ever, and we generally live longer, but sadly too often in poor or bad health. The 100-year life will indeed create challenges, but one upshot will be that we will have to see home ownership operating in a different relation to the rest of the finance, of our finances, including how we fund old age. I've left the two biggest challenges to last. First, addressing the challenge of climate change. To get global temperatures onto a trajectory that rises at less than 2 degrees centigrade will require the biggest investment in energy transition the world has ever seen. A net 29 trillion between now and 2015 is a reasonable estimate. This money won't all come from government. It will require institutional investment. It will require engagement to support companies and economies in transition. And it will require us to invest in new infrastructure and in new technology. Economics and the environment has to align to provide mainstream solutions. Either that, or it will be extinction rebellion that will be calling the shots. I am really optimistic that achieving the necessary change is possible, although we've only just begun. We've already seen the price of renewable wind energy fall far below that of fossil fuels. We've seen the price of solar panels falling by 80–90% as their efficiency rises. Electric vehicle charging is a viable infrastructure investment. We will all be driving electric vehicles or sitting in electric buses much quicker than we think. But our financial services industry has to work with our regulators, which we are doing, but also with our governments, which we are doing. We have to push our agenda forward. The right policy nudges, for example, on issues like retrofitting housing to improve energy efficiency, combined with the financial products that make it worthwhile for customers, is absolutely what we should be doing. Holland and Germany and many other countries have made much more progress than we have. Making investment inclusive. We could have an entire conference on finance and climate, but I want to highlight one other challenge. We are believers at Legal & General in inclusive capitalism. It is closely aligned with engagement. Historically, private investments have massively outperformed and consistently outperformed those in listed securities by over 5% annually for the last 20 years. But what is available to high net worth individuals or angel investors is not accessible to the rest. For example, workplace pension savers in default schemes, as the majority of people are. This not only creates what we've called the exclusivity gap on this slide, it is also denied a source of capital for scale-ups, which could move UK industry onto a much firmer footing. So we are really strong supporters of VC into DC, an idea from the Patient Capital Review that has been taken forward both by the government and the British Business Bank, and take it forward with a huge degree of enthusiasm. By simply changing the permitted link rules that allow a small, say 3 or 5% allocation from long-term DC funds into these various new investment categories, we would significantly positively improve the funding landscape for British business. I hope that many of you here will support us in this endeavour. Delivering the vision. We are the we. There isn't a they who can stop us. The power of pensions is very real. The power of pensions is very big. In a simpler age, our purpose was very narrow. When Bismarck introduced the German state pension, his aim was to provide a modest income for a couple of years when people could no longer work. For most of the 20th century, our industry successfully supported simple social objectives. Today, the canvas is much broader and much more complicated, but at its heart, it is about delivering objectives which are both economically and socially useful. I know as an industry, we can all rise to that challenge. Thank you.
So thank you, Nigel. We've got a few minutes now for some questions, and thank you for all those people that's already submitted via the app. So I'm just going to start with questions from here. So Nigel, are you okay to talk a little bit about the difference between the moral and commercial factors? So do you invest in these things because it's profitable or because it's right, and kind of what's the dynamic between those?
I think it's somebody should write a PhD on that, but I'm going to try and cover it in 45 seconds. It's both, and I think this theme of inclusive capitalism, and it's described as many other things, sustainable capitalism or various other things, is for real, and I think people get massively engaged in seeing and is believing. And this idea that you can engage more by using mobile phones is the right thing to do, and really get engaged in the sorts of investments we all want to see. We all want better cities, we all want better infrastructure, we all want to finance new great companies here in the UK. And there isn't anything to stop us doing that now. I think most of the regulation and legislation has been changed that allows us to do that. And it's not going to go away, because I think particularly both generations, but the younger generation and older generation, are hugely supportive of these types of investments.
And on that, the pension city seems to have captured the audience imagination. There's quite a few comments around that, particularly around the thoughts around engagement. So what are your thoughts on the biggest barriers to engagements, and also your thoughts on your best ideas on how to create engagement?
Well, I think we're going to get an expert on engagement following me on. But I think just talking about all this thing is a really important part of stuff. We've all been embarrassed over time not to talk about our pensions. We're obsessed about housing and not so much on pension. And I've always wanted schools to teach money. We've had various programs in schools to try and get people to be more financially literate, because it causes huge problems in later life, not just with indebtedness, but also with depression and various other things. And we really have to create a financially literate people, particularly in a world of pensions freedoms, and with all of the options that are now available for people choosing different lifestyles and the economic consequences of those different lifestyles and job opportunities. The other great thing I think that's going to happen is you and me and various people won't have to move south to get a great job, because I think what we're seeing here in Manchester, and indeed parts of Yorkshire that you have come from, in Leeds and Newcastle, is these great cities are transforming themselves. They didn't used to be so dependent on London. For the last 30 or 40 years, there's been this incredible dependence on London. That's gone. And one of the unintended consequences of Brexit is everybody in London's been obsessed about the bubble in London, whereas actually out in the provinces, people have got on with stuff. Cardiff's transformed itself, Newcastle is transforming itself, Leeds is doing a great job. We've invested with our partners around 3 billion here in Manchester, or committed to investing about 3 billion. And there's wonderful investment opportunities that are not driven by Legal and General, but are driven by the local politicians, the business people, and the brilliant young entrepreneurs there are in these towns and cities that are pouring out of these wonderful universities that we have here in the UK.
So thank you, Nigel, and apologies that we didn't get through all your questions. Nigel's going to be around for the rest of the day, so please do feel free to catch him and discuss anything that you've heard in this session. Just a quick reminder before we finish, please do rate this session in the app. And I just want to thank Nigel one more time.